Hello and welcome to week 6. This week we're going to be covering chapters 23 and 24. Chapter 23 is on the audit of cash and financial instruments. I'm just going to go over the first two learning objectives for this chapter. The first one is to identify the major types of cash and financial instruments accounts maintained by business entities. So first we have the general cash account, and for most organizations, this is virtually all cash receipts and disbursements, and they flow through this account. The relationship of the general cash account to other cash accounts is shown in figure 23-1, which we will review in a moment. Impressed accounts. Many companies establish a separate account for payroll to improve internal control over payroll disbursements. Branch bank accounts. Companies operate in multiple locations, often have several separate bank accounts at each location. Impressed petty cash fund. This is not a bank account, but a preset amount of cash that's kept on hand for incidental expenses. And then financial instruments, investments in marketable securities, derivative instruments, and hedging activities. And so this next slide shows a relationship of general cash to other cash accounts. So you see the T account here in the middle of general cash. You can see that it is connected to the impressed payroll T account, the impressed petty cash fund, cash equivalents, which is anything that can be converted to cash in 90 days or less, and branch bank accounts. And these all tie back into the general cash account. The branch bank accounts would flow money into the general cash account. The general cash account would flow money to the impressed payroll account and the impressed petty fund account. The cash equivalents would flow both in and out of the general cash account. Next is to show the relationship of cash in the bank to the various transaction cycles. So understanding the relationship between cash in the bank and other transaction cycles serves two purposes. It shows the importance of audit test of various transaction cycles on the audit of cash, and it aids in further understanding of the integration of different transaction cycles. And we will take a look at the relationship of cash in the bank and transaction cycles here. Okay, so we have capital stock, common capital stock, dividends payable, and paid in capital of excess par. For common stock, we have acquisitions and payment cycle. This is your accounts payable account. Payroll and personnel cycle. This includes accrued wages, salaries, bonuses, and commissions, withheld income taxes and other deductions, and accrued payroll tax expense. And then here we have sales and collection cycle. We have gross sales, accounts receivable, and cash discounts taken. And you can see that capital stock, common stock, flows into the cash in the bank. And it actually flows both ways. So if they sell stock, they would be flowing cash into the cash in the bank. If they purchase stock or buy back stock, it's going to flow back into cash in the bank. And you can just follow all of the arrows here to see how the cash is flowing. So, for example, accounts payable, you would see cash from the bank flowing into cash accounts payable. Same thing for payments in the payroll and personnel cycle. you would see money flowing from the cash in the bank into those accounts. So auditors have to distinguish between verifying the client's reconciliation of the cash balance and verifying whether cash recorded in the general ledger correctly reflects all cash transactions that occurred. Test of bank reconciliation also is going to often identify these types of misstatements: failure to include a check that has not cleared the bank on the outstanding checklist, even though it's been recorded in the cash disbursements; cash received by the client subsequent to the balance sheet date but recorded as cash receipts in the current year; deposits recorded as cash receipts near the end of the year, deposited in the bank in the same month, and included in the bank reconciliation as a deposit in transit; payments on notes payable debited directly to the bank account by the bank but not entered in the client's records. And finally, reconciliation of cash most likely will not detect these types of misstatements. So failure to bill a customer, embezzlement of cash by intercepting cash receipts from customers before they are recorded and the account charged off as bad debt, duplicate payments of a vendor's invoice, improper payments of officers' personal expenditures, payments of raw materials that were not received, and payments to employees for hours that he or she never worked, and finally payment of interest to a related party for an amount in excess of the going rate. So this is just a quick overview of the first two learning objectives for Module 6, and I will see you in the discussion. Thank you for joining me.